All right, let's bring the December 19th, 2025 PTSA Board of Directors.
November.
You said December.
Did I see December?
You did, it's November.
November
Ready, but
19th,
November.
2025.
It's okay.
TTSA Board of Directors meeting to order. And with Rochelle at 9 o'clock. Rochelle, would you please take a roll call?
Yes. Director Cox,
Yeah, he's on mute. You're muted, Dale.
you're muted. You take yourself off a mute. I see you lip syncing there.
Okay,
Am I-
so can you hear me now?
I hear you now loud and clear. Director Cox is present. Director Wilkins,
Present.
Director Clement,
Present.
Director Hansford, yeah, and Director Wilson.
Here on some November day. Before we do the Pledge of Allegiance, I would like to let everybody know that we have a 10:30 mandatory closed session. There's a time restraint on it. So if we don't finish the open meeting before then, we will move into a closed session. With that, please join me for the Pledge of Allegiance. I pledge
Allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Looks like we have a lot of people in the audience. Does anyone wish to make a public comment on any item that is not on the listed agenda? Rochelle, do we have any written or?
We do not.
Okay, thank you. And now we would move to review and adopt the agenda. Do any directors wish to adjust or move any items on the consent agenda or regular agenda this time? Okay, seeing none, anybody like to make a motion to adopt the agenda?
Second.
Second by Bert. All in favor, say aye.
Aye.
Thank you. Oh,
And we have to do roll call since we have
okay,
two directors who are participating in a video conference. So I'll go ahead and do that. Director Cox,
Yes.
Director Wilkins,
Yes.
Director Clement,
Yes.
Director Hansford, and Director Wilson.
yes,
Motion approved.
okay. And with that, I believe, Vicky, you are up.
Good morning, President Wilson and directors. Vicky Lefront, Human Resources Administrator. And as we do on a regular and monthly basis, I would like to acknowledge some staff for their achievements. And this month he was unable to attend, but Matt Nitz from the Operations Department received his wastewater treatment plant operator grade 5 certification. So we wanted to acknowledge Matt and thank him for his continued education here at TTSA. Thanks, Matt.
So can somebody tell me what grade 5 actually means?
So for grade 5 wastewater, it's the highest grade that you can achieve
Okay,
in the wastewater series.
so that's
It's-
like the highest level?
Yeah, it's about a 4.5 hour test. So,
Wow.
yeah, it's a lot of math.
Certain facilities have different operations requirements, right, Michael?
Yes, depending on the level of the facility. And we're a grade 5 plant,
Okay.
so in order to be the chief plant operator designated that way, you have to have an equal level of certification to be able to be in those positions. So
Great, well, sounds like quite the achievement. Pretty good. Yes,
Vicky, do we give any kind of bonus for employees that achieve certification?
We do in certain circumstances, yes. We have a policy on that. And I believe it is $250 bonus for getting an over certification. Over certification. So, generally for each classification, it is identified what level of certification they need. And in this case, this employee needs a level or a grade 3 operator certification for his position, but he has opted to overtest and become over certified. Therefore, offering the plant just a little bit more education and operators that are ready, any hopefully never any kind of need. But
Thank you. With that, let's move on to the consent agenda. Do any directors wish to adjust or move any items on the consent agenda or ask for a motion to approve? I did ask the board clerk to make a correction. And I believe, Rochelle, that was,
Yes, it was for directors present and directors absent were Dan Wilkins.
Yeah.
One and the same. So, I have made that correction on the original document. That will be reflected in the approval minutes.
okay. So with that, I would look for a motion to approve the board meeting minutes for October 15th, 2025. And the
So moved.
ratification.
So moved.
And
Second.
you're not quite done, Dale. And the ratification of the general fund warrants paid in October of 2025. Any discussion or questions? Okay, now we'll look for a motion, Dale.
So moved.
Okay, second. Thank you, Dan. With that, again, we have to do a roll call, correct?
Correct.
Okay,
Director Cox,
Yes.
Director Wilkins,
Yes.
Director Clement,
Yes.
Director Hansford. Yeah. And Director Wilson.
yes,
Motion approved.
great. We'll move on to the regular agenda. Consideration and approval of ordinance number 1-2025, amending ordinance number 02-215.
Good morning, President Wilson, members of the board. I continually forget to introduce myself, so I'm Liz Cook, your fearless finance lead, official title CFO and risk manager. For this item, I'm here to talk about our ordinance that controls our connection charges. We've talked a lot in this setting about connection charges, and last month I brought an item that would coincide with the ordinance, and it would be a standalone policy.
Dale, could you mute if you're on the phone, please?
I'm trying. Rochelle, my computer says that, it's about ready to close out. And, I've got the power mode plugged in, so something's gone haywire here. I might lose you. But go ahead.
Continue.
Okay, thank you, Liz.
So last month I came here with a standalone policy as well as the ordinance with the intent to have an automatic inflator for adjustment applied every January 1. At the recommendation of the board, back before the board today is an updated ordinance that incorporates that automatic update. The ordinance also lays out what the index will be for this January 1. The Engineering News Record Construction Cost Index, I'm going to call it the ENR going forward for this presentation, is the index that we selected, and the November to November rate was an increase of 3.4%. So the charges associated with the ordinance have been inflated by that, assuming acceptance of this ordinance here. It really is housekeeping in nature by adding that automatic inflator, and come this time next year, we won't have to go set up so that we won't have to come back and redo the ordinance. We'll bring an informational item to the board in December. If we can get the index reported out in November, I'm happy to bring it earlier. It just usually comes out right in time for the board packet. So before you today is the approval of the ordinance, which would establish the annual adjustment index for the connection charges based on that ENR. It would be effective every January 1 until we change the ordinance.
Good.
Happy to answer any questions.
Dan, any questions?
No questions.
Dale?
No questions.
When's the last time we had an escalator on it?
We have never put an escalator on it. Last time we updated this ordinance was the first time we had increased rates in about 20 years. So we're trying to maintain and not fall back into that
Okay.
bucket of not inflating it.
So we didn't have a catch-up charge.
When we increased the rates, it was 70+% because we did have to catch up. It was based on current assets. There was a full report given to the board and it was talked about for a good 6 months before they decided to do the increase.
Got it.
And that was effective last January.
Thank you.
It was a 5-year, if I'm not mistaken.
The idea is that we don't let it go more than 3 to 5 years without going back and looking at the report, assuming that the makeup of our CIP or the assets that we could be charging for haven't changed. We all know we have an increasingly sized project coming up. So I don't see this index just being applied for 3 to 5 years. I see us redoing the report, but we need to get a little further down our timelines for the project before we can do that.
Okay.
So for now, the safest thing for the agency and the best to make sure that we're staying up with that construction cost is to apply this inflator.
Yeah, and Bert, it had been,
Yeah, 20 years, long time.
it was, yeah, it created some issues, so you came out at a very good time, I'm sure. That hard work was done, so. Okay. Do we have any questions or comments from the public? Seeing none, I will entertain a motion to approve.
Make a motion to approve ordinance 0-2025.
Second.
And the roll call is necessary.
Director Cox,
Yes.
Director Wilkins,
Yes.
Director Clement,
Yes.
Director Hansberg. Yes. And Director Wilson.
Yes,
Motion approved. Thank you very much.
thank you for this. And now we move on to consideration and approval of the permit portal replacement contract. That's a lot of stuff.
It is. Morning, Board of Directors. I'm Luke Swan, the IT supervisor for the IT group here at the agency. And so this, this item kind of is coincides and ties in with Liz's item with changing the rates based on the index every year. And so right now, our current permit portal was built back in 2019 and is now severely outdated. And so for us to continue to update rates within it, we have to go in, break the code, rewrite it, redeploy it onto on-site servers. It's just minimal support structure for it, and the software is on behind as it is built now. So we want to partner with Logically, which is our MSP that we use right now for our cybersecurity backup services, to build a new what I call quote permit portal within Microsoft's. It's called their Dataverse. This will allow us to make use of the enterprise grade security on the government cloud, seamless integration with other Microsoft applications, Power Automate, Azure, Entra. I know these are buzzwords within the Microsoft sphere. But then it also is a low code platform allowing us to use drag and drop tools, allowing us to use pre-built tools, different things that make it more user friendly for IT staff. Doesn't require specialized training. Obviously, doesn't require Microsoft training, which is readily available, and we have access to that with in-house. The reason we want to replace this, obviously, right? We've been breaking the code. We've been redeploying. It's been difficult. We've been migrating away from this system. This system also integrated with our old PIS, which is called Plant Information System. We've replaced that with Lucity, which is our CMMS system, which maintenance leverages heavily. We've also replaced this PIS system with WIMS, this Water Information Management System, which operations uses heavily now. So this is just a journey that we've been on over the last 4 or 5 years to replace these in-house build programs with enterprise grade supported systems. And this is just one of those last steps that we are trying to take with this. Fiscal impact for this is $49,200, 10% contingency, and we'd like to recommend that the board approve us enter into contract with Logically.
That's an annual amount?
No, that is a one-time amount. There will be reoccurring annual licenses with Microsoft in the range of about $2,000.
So logically interfaces with Lucidity better than, how does all that, oh, I mean, there was a lot of things, but bottom line, it makes it easier and prepares us.
Yeah, logically, Logic is our MSP, our managed service provider.
Okay,
So they're actually the company that is going to help us build the product.
okay,
We're leveraging Microsoft's software tools and an automated platform to build the portal and the interface for our member districts to log in and create permits
okay.
for the system or for our agency.
It's similar to the model we use for kind of design work where we like kind of run all to do design work for control.
Yes.
So we're moving to a model where we're using a third-party consultant to do all this development.
So in essence, we're taking advantage of the technology that's out there and make it easier.
Right, like we're using Microsoft Teams. It is the software licensing that we already have and leverage and pay for. We're going to be using this same type of model, albeit we have a couple other premiums to add on to be $2,000 a year, but we're still using within the Microsoft ecosphere and not building anything outside of it.
I just have one question. So this portal is an internal portal, but the other agencies can access, but it's not a public facing.
Correct, yeah. It will be, yes. Other agencies will have credentials to access it. They will be able to access it from outside, but it is a internal portal. It's not an external.
And what was the process for us choosing? Are there other ones out there that do this, or is it?
We did go out to Civic Plus, which hosts our website and also hosts our Civic Agenda meetings, which Rochelle uses monthly to make all the financial committee and board agenda stuff, say documents. They had just a straight out of the box, like a town permitting system where people could apply for electrical permits, plumbing permits, and it did not fit our model and workflows that we had. We worked really hard with them to do that because we were okay, because they'd given us good product before, but they couldn't customize it within their software system. Microsoft Dataverse and the SharePoint allows us to build customizable tables, databases, allows us to make customizable forms within Microsoft, right? We're not building these ad hoc. We are building ad hoc, but they're within Microsoft's tools and allows us to customize our permitting process and workflows.
Okay, thank you. Any further questions from the board? Any questions from public? Comments? Seeing none, I'll entertain a motion to approve the permit portal replacement contract. Have a motion?
Make a motion that we approve the contract to. Oh, gee. Sorry, Jack, what's the name of it?
Yeah, Logic.
Luke, you help me out.
Yes, I'm sorry, yeah, Logic, Logic.
Thank you. Okay.
Do we have a second?
Second.
Thank you, Bert. And with that, take a roll call.
Director Cox,
Yes.
Director Wilkins,
Yes.
Director Cummings,
Yes.
Director Hansberg,
Yes.
and Director Wilson.
Yes.
Motion approved.
All right.
Thank you very much.
Thank you, Luke. Great explanation of something
It's complicated.
yeah. All right, Liz, good to see you again.
Welcome back. I'm gonna be a while, so everyone get comfortable. I think I have the next 3 or 4 items. Right. Well, for this presentation, I'm going to review with you the financial results for the month ending October 31. In full transparency, it was a dual packet week and some items that typically just belong in the finance committee made their way to the board agenda packet. So since they're on the agenda, it's great information. I'll cover that. The board did give direction to not have to bring the monthly financials to this full board every month because we do cover it with the finance committee. If you change your mind after this some presentation, let me know and I'll add it back. Yeah, I just made it word. Let me advance a little bit. There we go. Okay, so let's take a look at our financials for month ending October 31, 2025. As of that date, we are 34% of the fiscal year elapsed. Everyone just take a breath with that. Holy cow. Our revenues, which are what are reflected on this slide, again, the first bar is Fund 10, the second bar is Fund 2. We don't have the other funds because their revenue is really just fund interest. It's not driven by anything else. So for our general Fund 10, the budget to actuals, we're trending right along with the elapsed fiscal year. The yellow dot represents where we should be at. The entire bar is the budget, and the blue that is eating up the green is showing you how our revenues are growing. So you can see that the bar is right along with the dot. We're trending with rates. Same thing for Fund 2. Our connection charges are coming in. In the future quarters, when I bring our quarterly report to this board, we'll talk more about any impact we've seen or any cost changes or revenue increases based on that inflator that we added. Any questions on revenue before I switch to expenses? Okay, and then I have the clicker. So let's take a look at expenses. Similar story for our general fund 10. We're trending right along with our fiscal year. Again, we do have a few larger payments that happen in the beginning of the year. We tend to balance out as the year progresses. You will see a typical story that I've stood here and told before. Our capital projects are a little slow to get started, but we do anticipate ramping up that spending as we continue through the fiscal year. So we'll keep an eye on that. Any particular questions about the monthly expenditures for any of the funds?
Nope.
I'll take stunned silence. Let's go to the cash graphs. These reflect our fund balances. As of October 31st, we had approximately $43 million in cash and investments in the bank. It's a great story. We increased our rates to be able to fund capital projects. We're seeing that funding come in. We're going to get started on that spending. So this was a review and comment item. It was not an action item. Are there any comments or questions?
Only comment I have is, good job. I mean, I think there was a lot of thought that went into this, and you guys are definitely following along where you want to go. So thank you.
Rochelle, do we need to take a formal roll call if it wasn't an actionable item? Okay. If everyone is acceptable with this, I'll move right along into the next agenda item, which is to review and comment on the agency quarterly investment report. Similar story with this report. It has not come to the board before. It is reviewed at finance committee every quarter. So let me paint a picture for you. As part of the fiduciary oversight of the finance committee, this is why we talk about it. Oh, let me do the presentation first. I forgot I was in charge of that. Okay, welcome back. So this is part of the finance committee's fiduciary oversight. We have two vehicles for investments in our portfolio currently. Pause. Yet to come is we will bring an investment report back in the next few months to update the investment policy so that potentially we could add some additional vehicles and have our money continue to make more money for us. But in the setting of economic uncertainty, which we've seen for the last few quarters, we have been very successful with our two items in our portfolio. So we have a CD portfolio. This will lay out all of the CDs that we have, and it also lays out the 5-year laddering approach that we have. Time value investments, or TVI is how you'll hear me refer to it, is the company that manages our CD portfolio. At the end of this, actually, at the end of past the quarter, so it's not reflected in here, but you see those 3 highlighted CDs up at the top. They have matured and we have since reinvested them. So it will reflect on the next quarterly report, but since it happened in the actual time before I was talking about it, I wanted to note it. What we did for that approach of the reinvestment, if you see the middle years where the bars are a little bit lower and we don't have as high of a percentage, we wanted to fill in some of those gaps so that we have that ladder a little more levelized. That's one thing that we take into consideration when we recommend reinvestments for GM approval. The other item is to maximize yield. So we're taking a look at both. Any questions on CDs, particularly before I talk real quickly about the treasury program?
Nope.
So our treasury portfolio is managed by an independent municipal advisor. Stephen's actually in the audience, and you'll hear him talk a little bit later when we get into our bond issuance as well, because he helps us on both sides of the house. As of September 30, we have 1 treasury that matured. We brought in approximately $5.6 million that was available to reinvest. We have taken the approach of rolling these every 6 months, and we haven't deviated from that. We've been able to maximize yield and again, continue to have our money make money for us. All of these investments are aligned with government code, and the government code is what we will use to expand our current investment policy in the future so that we can have other items in our portfolio. Are there questions about the quarterly investment report?
Yeah, I was just a little surprised that our yield was at 4.22 and Lake's 4.24. I thought we'd be nice to slightly exceed Lake's performance. And I know CalFast has been outperforming Lake, not as much recently as it had in the past. But any kind of story behind this matter?
Helps when you have your advisor in the audience.
So there was a period of time where interest rates were rising relatively rapidly when inflation was a big problem. And during that period, treasury rates were far in excess of Lake. 100 basis points, 150 basis points, historical spread. So there was a huge advantage to buying treasury securities. Now we're in a declining interest rate environment, and so treasuries go down much more quickly. Lake is hanging on to some older investments that they bought years ago when rates were higher. So for the foreseeable future, at the current trends, it's likely that treasuries will underperform Lake. Short-term treasuries, 3, 6, 9, 12-month treasuries. You could buy longer-term treasuries, which would be illiquid, not illiquid, but generally buy longer-term investments as a public agency. And so it's likely that your treasury program is going to continue to underperform Lake, as we go forward. That will also become true of your CDs. They're going to come down when you reinvest. And so Lake is actually, going to end up being a good deal for a while until we get to a situation where rates, turn around.
I guess just does it make sense to keep rolling the money into the treasury program right now?
The general approach is diversification is a good strategy. Lake is good, right? But it's not bulletproof. It has some, exposures. And so, it might not be optimal to put all of your money in Lake, even if the rate's a little bit higher, diversifying a little bit among other instruments that are federally guaranteed that you own, such as your treasury program and your CDs. Those are securities that you own in your own name and that they're guaranteed by the US Treasury. And so that provides a level of security and protection that you don't get quite from Lake. Not that Lake isn't safe. Everybody loves Lake. I love Lake. We all love Lake, but just as a prudence matter, diversification is a good approach to investing. Putting all of your money into Lake might not be as prudent as diversifying a little bit.
So one thing we can do is that this treasury will expire or mature on March 31st. So at the March Finance Committee meeting, we will make sure to bring a recommendation and do some of those analyticals and potentially think about maybe not putting all of it back in treasury, maybe putting some of it in Lake and having that conversation up.
Yeah.
So I'm sorry,
No, go ahead.
unless you know what the underlying assets are that Lath is investing in, I wouldn't recommend that.
Lake is very conservative. It's very similar to CalClass in that, the way they outperform the treasury market and the CDs, they buy things like commercial paper, like highly rated corporate bonds, things that have higher yields. They're not quite as safe, but they're very cautious in how they buy these various other types of instruments. So they take a conventional approach to trying to build up their yield a little bit by buying some types of investments that have slightly higher yield than treasuries. Because treasuries are so safe, they have lower yields. Commercial paper, corporate bonds are a little bit more risky, and so they have higher yields. So, Lake is run by the state treasurer on behalf of the state and all the local public agencies, so they have, a high priority that they place on liquidity and safety. So, nobody is worrying about Lake. It's just a matter of, 100% or 75% or 50%. That's the discussion.
Yeah, I understand, but we said that with AAA rated CDOs back in 2007 and 2008. So I hear you, but not a fan.
That's, can't dispute that. That's true.
You definitely can.
Sounds like it will be a spicy conversation in the finance in the future.
After January.
after the changing of the guards happened. Are there any other questions or comments on the quarterly investment?
Just following, in March, you'll be bringing this back.
So I had not intended, this is not something that rises to the board level in the past. If the board likes this information, we can definitely take it out of committee and bring it to the board as well.
I feel very confident in the committee at that point.
Got it. Should that change with committee updates to the board, we can involve that. It does, it's always on a 1 month lag. I need a little bit of time to look at the numbers. So that's why we're doing quarterly reports.
Further questions or public comment? Yes.
I'm still here. I'm not going anywhere. All right. That wasn't a review and comment. We went through the review and comment. So as we noted on the last item, there was no roll call necessary. This one will be the same. This is a review and comment on the agency quarterly financial plan update. This is intended for the full board audience, and this was the trade-off of not seeing the monthly financial, but looking at quarterly and seeing projections. I will note this is the first time I have brought it in this capacity to the board, always looking for feedback on other items or more details that we want to have included. For this snapshot, I stuck with the charts that we use in the budget book, feeling that the board had a really good understanding of those summaries. So I wanted to at least start there. So on the very first slide, should be familiar with what I call the executive summary. This lays out all of our fund balances as of a particular date. For this chart, it is the date of September 30, which was the end of the first quarter. It's laid out by all of our funds. It anticipates what our revenue to come is. It anticipates what our expenditures to go out will be. And then we have that reserve policy as it is right now, where we need to take money from Fund 10 to fund the projects in Fund 6. So let's take a look at these numbers. As of September 30th, we had approximately $44.4 million in cash equivalents in the funds. Going through all of the analysis for this, I'm projecting that we'll end the fiscal year, so June 30, 2026, with about $37 million in the bank. So let's walk down the general fund column right now. The fund balance of that approximate 17 million is a net of the ins and outs of the first quarter. Projections indicate that another $22.3 million will come into that fund. We'll talk about cash in January when we usually see our first tier payment. The balance or remaining expenditures for the rest of the fiscal year are about $15.5 million, and we'll have details on the next slide of what those are, which would end that Fund 10 about $24 million, leaving the excess of that $7 million that's needed to hit that Fund 6 target and to cover our priority ones in the replacement and rehabilitation and upgrade fund. So the FY26 projected year ending balance would be about $17 million. Now you'll notice I didn't teach how that impacts for our reserve target for the upcoming fiscal year, because next month, along with a bunch of other items, I'm going to bring back an updated reserve policy for consideration that will lay this out a little bit differently. I will also bring this table back to show you the comparison of what changed, but that's why I didn't continue that. It is a much shorter story for Fund 2 and Fund 6. For the wastewater capital reserve, we anticipate about another slightly under $2 million coming in. We're projecting expenses of about $3 million, so we'll end there with about $16 million in that fund. You'll see for Fund 6, the replacement, rehab, and upgrade fund, we spend all of our money. That's how this chart has my tenure here. And that's really where bringing the CIP and taking it out of the budget priority category that we have will change the dynamics of that. So again, this report will evolve as we continue through this fiscal year. Emergency contingency fund, we absolutely think we'll make our investment targets there. And so we'll have a little bit of an overage we can put back into Fund 6 as well. Are there questions on the executive summary before I talk a little bit more detail of each fund?
We're good.
I'm gonna take some silence again as we go. All right, let's look at Fund 10. So the top part of the chart, just like in the budget book, lays out the revenues. The first column reminds you what the FY26 budget was. The next column is our year-to-date actual as of September 30. Remember that these are quarterly projections, so it's not going to tie to that October financial you have in your packets. The next column is how we've projected out the expenditures for the rest of the fiscal year and where we think we'll end it. And then the next column shows you the variance, whether we're gonna be above or below budget. One thing I'll point out here for revenue, other revenue, you'll see that the variance to budget is high. It's because we parked the cash there that's related to the OPEB premium reimbursement for retirees that we have. Working with accounting to figure out maybe there's a better account to put it in. It's not anticipated revenue. It offset costs from last year, but we received it this year. So we need to recognize it somewhere here on these financial and our revenue accounts. That one-time payment was not factored into the projections into that. We just took that run rate from the $75,000 to get to our total projected amount. On the expenditure side, the biggest story is labor savings. No one should be surprised by that. When we rolled in at budget time, we had 4 vacant positions and we added 4 new positions. Those positions are still vacant. We'll talk about one of them in a little bit, but if we hire in, we'll start to erode at that $1 million that's there. And we'll talk about that each quarter. The insurance is really right now the only line item that's projected to go over, and the board is aware of the circumstances that could. Are there particular questions on the revenue or expenditure projections for Fund 10? So taking a look at wastewater capital reserve fund 2, same thing for our revenue. We're anticipating projecting 100% of our budget at this point in time. We don't have any reason to deviate from that. From an expenditure standpoint, the budget right now is only projecting and assuming that we're spending on priority 1 and potentially priority 2 projects. Again, we've had that conversation. It seems a little awkward that we have these priority 3 in there that we don't necessarily have budget for in Fund 6, but live in there because of CIPs embedded in that. That will change for FY27, and we'll have conversations with the first part of the calendar year on the actual CIP delivery. So for Fund 2, we're anticipating spending the entire priority 1, priority 2 because it's related to security. That's physical security improvement. It's card readers on some of the doors. We were doing some follow-up work from the project last year. So that's why that's projected to be spent. But you'll see that we're not projecting to spend any beginning level priority. We will be making our bond payment, but that doesn't happen until later in the year, so you don't see any year-to-date actuals for that yet. Questions on wastewater capital reserve fund 2? Rolling right along. Okay, fund 6. Looking at replacement, rehabilitation, and upgrade. Always a mouthful. Again, we anticipate recognizing the full fund interest budget of the $250,000. I am very conservative when it comes to these projections with only Q1 numbers. You may see some more variances or have more knowledge when we come to the Q2 conversation, and we may see adjustments there. Same story here. We're anticipating only spending the priority 1 level projects, and primarily that's digestion improvement. It's working on our Corolo contract for the nutrient project. There is 1 priority 2 project that was already spent. And that is the only item out of the priority 2 category that we anticipate spending at this time. And then you'll see that we didn't anticipate the priority 3. As a reminder, there's that line item at the bottom called rollover from FY25, and it didn't necessarily have an assigned budget. There are projects that they were budgeted in the prior fiscal year, but the cash flow or the timing of receiving it was such that we had to pay for it in this fiscal year. So when we did the target balances, I made sure to balance that out. That's why we're not reflecting incremental budget here. And same story for the debt payment. We'll make that in the second half of the fiscal year. Questions on the projections for replacement, rehabilitation, and upgrade fund 6? I'll take it.
Yeah.
I'm still here, also not leaving yet. Okay, that's a care review and comment on our quarterly financial plan update. Now we're going to get into the meat of what we're going to be here to talk about, at least from my perspective. We are going to be looking for a nod from the board. It is not an action item. This is informational, but we wanted to have the conversation with the board as we lay out the roadmap for the next few months. And we are looking for a nod from the board that this is the roadmap that you'd like us to continue on. I am going to read a little update here. Again, double packets, and I can view the staff report. So this is what you should have seen in the packet. You all got the finance committee report in that. Last month, the agency held a debt 101 workshop that introduced the main financing options available for capital projects, including municipal bonds, SRF and WIFIA loans, bank lines of credit, and direct private placement. This session outlined the pros and cons of each option and discussed how factors like project size, timing, market conditions, and the agency's financial position affect the choice of the financing. Today's session will build on that foundation and take a closer look specifically at municipal bonds, aiming to give the board a clear understanding of the bond financing process and a recommended path forward for securing long-term funding. We have Stephen Gortler, our municipal advisor here, who will carry some of the conversation. We also have Dave Fama from Jones Hall, our bond counsel, which Stephen will talk about the role that bond counsel plays. He's here also to answer questions. And just to set the stage, over the next 2 to 3 years, the agency expects to spend approximately $50 million on digestion improvement and nutrient removal improvement projects. Remember, over the next 2 to 3 years, we're going to spend more. We're only talking about the immediate future right now. As part of today's presentation, bond counsel and the municipal advisor will discuss the potential issuance of up to $25 million in wastewater revenue bonds to help fund these projects. Issuing bonds for this purpose will help the agency preserve and build its cash balances and position us to meet larger capital needs in the future as the project progresses. I wanted to know why we came up with the $25 million recommendation. And if you take a look at the CIP that's in the budget book right now, which is what the rating agency will do, the next 2 years, priority 1 of Fund 6 total approximately $25 million. It felt like a good place to start. We all know that the project is going to cost more than $25 million, but we have to start somewhere. Now is a good time. We feel confident that we can spend that amount of money in the 3 years that we would have to keep it tax exempt. And so that's why we came to that conclusion of the recommended amount, $25 million bond issuance. So I'm going to turn it over to Stephen. Oh, I'll apologize. I did not pull up the slides. I'm doing terrible at this. Stephen's going to carry the conversation and walk you through the timeline, some of the requirements, talking about the JPA, and then I'll come back to wrap up.
Just before I run into start on the presentation, just to expand a little bit on what Liz was just saying. It looks like in the next 5 to 10 years, there's a good possibility that we may embark on a very large, very costly capital program. The numbers have been thrown about hundreds of millions of dollars. 5 years, 10 years, it's all sort of a little bit vague to me, but I know that it's out there. And so really a lot of what we're talking about today is with that exact, possibility in mind. We've talked about this quite a bit in the past. And if in fact, 2 or 3 or 4 years from now, you're going to start to commit to 100, 200 some odd $1 billion capital outlays over, 3, 5, 6, 7 years for the nutrient removal project, then what you're doing right now is going to position you better to take on those obligations. By building up your cash over the next few years, it will strengthen your balance sheet. That will make you more creditworthy, and it will make it easier for you to go into the capital markets to borrow money. It will also allow you to use some of your cash that you accumulate between now and then to pay for some of those capital outlays. So when you start to fund $100 or $200 million worth of projects, you'll be like, okay, we've got $25 to $50 million that we're going to put into the project. We need to borrow another $50 to $100 million. That's a good story to tell lenders. It will make you much more of a credible borrower. So the idea here is this is really a borrowing in anticipation of creating some capacity for future borrowing. You have plenty of cash flow right now, so in theory, you could pay for all these projects over the next year or two from your cash and from your revenues. But I think that's a little bit short-sighted because a few years from now, you may, kind of regret having done that. So that's kind of like the theory behind this whole thing. Okay, so the presentation, I'll try and go quickly because I know we've got a clock. The page, this page right here, this is really kind of like a schedule that we put together. It outlines the key steps in the process, the milestones, what has to occur between now and the end of the process in order to succeed and so forth. So it gives you a little bit of a roadmap of what's going to come. Here you got, Wednesday, today, November 19th, preview of the upcoming bond issue. As Liz said, this is just an information item so that you have a sense about what's being considered. There's a meeting on December 4th of CSCDA. We'll talk about this a little bit more in a few minutes. But the idea there is that in order for you to issue bonds, you want to engage to form a JPA and have the JPA issue the bonds for you, because as a public agency under state law, you can't issue the bonds yourself. There are other types of debt that you can issue, but you can't issue bonds yourself unless you go through a rather elaborate voter approval process and member district approval process and so forth. It's infeasible. We'll talk about that more in a minute. Early on in the process, there's the rating agency presentation, and we've got that down for the next, in the next few weeks. They need to assign a rating to the bonds so that investors can assess what the creditworthiness, what the riskiness is of the bonds, and that's how they establish whether they want to buy the bonds or not, what the interest rate they may charge you, and so forth. And so that's part of the process. You may recall back in 2020 when you issued refunding bonds, you went through the same process then, and the rating agency assigned a AA rating to your bonds at the time. That's a very good rating. Investors love AA rated wastewater bonds. And they kind of flock to buy those kinds of bonds. The big difference between then and now, perhaps, is that back in 2020, you were issuing $20 million worth of bonds with a 7-year maturity and no other debt. And so it was a very small and short amount of debt, very easy to gauge the risk. Now you're in a very different situation. You're looking at doing $25 million over a longer term with the prospect of doing hundreds of millions of dollars, in years to come. So it's much more risky profile for the agency than it was back in 2020. I still think that it's a AA rating is appropriate, but it's not a foregone conclusion because of what's going on and what's anticipated to occur. So there's a meeting on Wednesday, December 17th of the board. If everything goes according to plan, then that would be the time for an action item to bring to you the option of approving the issuance of the bonds or not. That doesn't mean the bonds necessarily have to be issued, but it authorizes staff to go forward with the bond issuance at the board's discretion. And then the rest of this is just kind of paperwork. Tidying everything up. There's a process early in January of marketing the bonds to investors. We leave a couple of weeks to notify the investors that there's a bond sale coming and to provide them with the documentation they need to evaluate the bonds and answer their questions and so forth and do that. And then we have a bond pricing scheduled for mid-January. That's a target date. Bond market conditions might be favorable or unfavorable. That may turn out to be a good day or a bad day. It might make sense to go, sooner or later. We'll have to kind of wait and see, but we make a target now so we can organize the schedule around it. And then it takes about 2 weeks from that point to close, to sign all the documents, execute everything, and to wire funds. So that's kind of like a little roadmap as to what the process looks like and some of the dates that we've penciled in. These are all kind of a little bit subject to change, except for that Wednesday, December 17th. That's probably not going to change. Before I go on, questions on that? Okay. A little transaction summary here, kind of some of the highlights. We talked about the JPA where it's contemplated that the issuer of the bonds would be the Town Truckee Sanitation Agency Financing Authority. That's a joint powers agency. Talk about that a little bit more in a few minutes. These would just be, your typical wastewater revenue bonds. These are contemplated to be fixed rate bonds. The interest rate on the bonds would be fixed at the time the bonds sale, not subject to change over the life of the bond. So your interest expense and debt service payment schedule would be locked in. These are tax exempt bonds, so you get a break on the interest rate because it's a governmental purpose. It's contemplated to issue $25 million on a net funded basis. What that means is that, it's going to take you a few years to spend $25 million. And during that period, the money is going to sit idle. And so typically what people such as yourselves do is when you issue the bonds, you might buy a little portfolio of treasury securities with those bonds, and they would mature in 6 months and 12 months and 18 months and 24 months in line with an anticipated draw schedule, so that you're earning interest in a safe investment at the same time that you're drawing down on the proceeds and spending them on the projects. So we calculate that you can have $25 million worth of proceeds on a net basis, including about $1.1 million worth of interest earnings that you'll earn over the 2-year period, together with about $23.9 million worth of proceeds at closing. So that's why it's $25 million net. We're looking at doing a 20-year financing. There's a number of different factors that went into the 20-year idea. Typically, an issuer such as yourself doing a bond financing would probably do a 30-year financing. That's pretty typical. But there's some reasons why it might make sense to do a shorter financing than 30 years. In your case, a couple of reasons why. Number one, and we'll talk about this more later, but interest rates are a little bit high right now. And so going 30 years would add quite a bit of additional interest cost to the debt. Shortening it up would save you quite a bit of interest. Also, your 2020 bonds that you have right now, they're going to mature in 2 more years. And that's $3 million a year in annual debt service. That I think it's 3. Is it 3? Hang on a second. We're in the 20 months. Yeah, $3 million. So you're paying $3 million a year right now in annual debt service. After 2 more years, that's going to be gone. That's going to free up $3 million worth of free cash flow that you don't have today that you could use to pay debt service on these other bonds. So you've got a lot more capacity to pay debt service and to issue debt now, which argues for maybe shortening it up a little bit since you have so much more capacity coming online. Security, these are a senior lien on your net revenues, which is almost always the case, which means that, you collect your gross revenues, your service charges and your property taxes, connection fees and all that. And the first priority, legally, the first priority is to use the money that you collect for operating costs. Operations and maintenance are a higher priority than debt service. Debt service is a second tier, if you will. It's a senior lien on the net revenues after you pay all your operating expenses. So just, it's kind of the legal structure. We talked about the sale date, the closing date, the payment dates. Here it says competitive public sale. This is something, because it's a wastewater revenue bond, which is very appealing to investors. And because Tahoe Truckee Sanitation Agency is a fairly large agency, generally speaking, in the marketplace, and a AA rating is a pretty good rating in the marketplace, and $25 million is a pretty good sized debt issuance, you're in a position to do a competitive sale. A competitive sale is simply as, like doing an RFP, where you let everybody know that there's some bonds for sale, you pick a date. We picked the date of January 14th at 8 a.m. Usually we do it at 8 a.m. And then we say to all the investors out there who might be interested, submit your bids to buy these bonds at 8 o'clock on the morning of the 14th. And whoever submits the best bid will win the bonds. We will award the bonds to them. And the bids really consist, for the most part, of an interest rate. Whoever is offering to buy your bonds at the lowest interest rate would be the winner of the bid, and they would win the bonds. And that's how we make sure that you get the best possible deal. Now, competitive sales like this are not that common. I mean, they are common, but not relatively speaking compared to all the bond sales that go on all the time. Most of the bond sales are done on a sole source basis where you negotiate the interest rate with the investor. But you've got a lot of attributes in your favor. As I said, wastewater revenue bonds, Tahoe Truckee Sanitation Agency is a good name. $25 million is a good name, AA rating. So a competitive sale is really a great option that should save you some money. We talked about optional prepayment. Excuse me. Like most bonds of this type, you can't prepay the bonds right away, but after 10 years, if interest rates should be in your favor, then you can issue new debt, pay off the old debt, perhaps lower the interest rate on the rest of the bonds, and have a debt service savings going forward. That's typically the case, and that would be likely to be the case here as well. And then, some of the players involved on the Disclosure Council, Jones Hall, Dave Thomas here from Jones Hall. Myself, my role is I'm actually serving as the municipal advisor. Is my designation. Questions on that?
It's fine. Just a question on the senior lien on net revenues. Is there ever any issue with that requirement if you were to get an SRF or a good deal?
Yeah, so, SRF loan has a lot of criteria. And so, let's say, for example, you have let's say you issue these bonds and then you want to get an SRF loan afterward. So you would have to comply with the SRF loan requirements, which these requirements that the legal requirements of this bond issue would be consistent with the legal requirements of an SRF loan. So this bond issue would not inhibit your ability to qualify for an SRF loan. In fact, if anything, the SRF loan has some covenants and criteria that are more liberal than investors require of these types of bonds. So it shouldn't be a problem. It never is a problem. And then the same thing holds true for a WIPIA loan. Same, kind of dynamic is in place, or if it were a bank line of credit or a private placement, nothing that you do here is going to limit your flexibility in the future to go in one direction or another.
Scott, I have a question,
Yes, Ben.
and it's probably for Liz or Jason. So how much investigation have we done into WIPIA or SRF as compared to this competitive bond sale? And the reason I ask is we're at the Tahoe City PUD, we're looking at borrowing some money to do some water system reconstruction on the West Shore. And, what we're seeing there is WIPIA and SRF being a cheaper money than a bond sale like we're talking about here.
Sure. Steve is gonna make one comment, then I'll wrap up.
Yeah, I would just, I think you're raising a good point. I just wanted to clarify, in today's marketplace, with the interest rate environment that we're in right now, a AA rating on the agency's debt would be a superior interest rate, a lower interest rate than a WIFIA loan. WIFIA loans are not lower than a AA rated competitively sold wastewater revenue bonds with a 20-year term in today's marketplace. So I don't want to dispute what you're saying, but I just wanted to clarify that in this instance, we look very closely at that. With regards to the SRF loan situation, though, however, it's way lower interest rate on an SRF loan. SRF loans have a 1.7% interest rate right now, which is superior to anything else in the marketplace. The problem there, though, is that it takes a year or 9 months to qualify for an SRF loan and to get funding, assuming that they approve your application. So there's a lengthy process involved in applying for and qualifying for an SRF loan.
Yeah, so I understand that SRF is a lengthy process. The money we're talking about right now, it's not like we need it next week. And quite frankly, if we can get, a couple, 2 or more percent improvement on our interest rate, even if that requires a longer time period, to qualify for the SRF loan, I'm not sure why we wouldn't pursue that.
Well, I'll take a stab at that one. We're not pursuing SRF. The portfolio of the nutrient improvement project is going to include other items besides bonds. Bonds right now, to Stephen's point, they're cheaper for us right this minute because we are a AA rated agency. We can use that cash right now. We can spend through it in the next 18 to 36 months. We'll have that at least 18-month waiting period for the SRF, and we might not be accepted. But as part of the funding strategy from the Carollo team, we are investigating all of those things for the larger portion. So you may see a combined portfolio where the recommendation is to issue a smaller amount, like the 25 million right now in bonds. Then we may come back and go, well, we're going to get 100 million through the SRF program, or we're going to get 150 million through WIFIA. We don't know. We're working with the Carollo team on that. They have expertise in analyzing it. They have expertise in filling out the applications. And so what I've asked of them to bring to the board is putting together a matrix of what all of those debt vehicles are and how we need to consider them for this project.
Okay, then a follow-up question for Stephen. So the nature of these bonds, if we wanted to pay them off early, if we were able to find cheap, let's say we sold the bonds and we end up with an interest rate of 4% or 5% or something like that. And then later we find we can get access to money at a lower percentage rate, 2%, 3%, whatever it is. What ability do we have to basically prepay the bonds, and what sunk costs would come along with that? Would it just be the cost of the initial bond financing? Or would it be that plus some kind of prepayment penalty?
Okay, a couple of things. So, these bonds will have a prepayment option. At the end of 10 years, you can prepay the bonds. If you can borrow at a lower rate in 10 years, then you can prepay the bonds. However,
So that's at the bottom, the optional prepayment, 10 years at par.
right, before then, you wouldn't have the ability to prepay the debt. And in any event, you could never use SRF loan proceeds to prepay a municipal bond. That would be, the tax provisions wouldn't allow that. To your other point, just to clarify, the money that the Carollo contract is now being used for is to do the design work on the nutrient removal project. That's 19 point some odd million dollars. I don't think that an SRF loan would fund that kind of outlay. What they would fund is at the end of the design work, if you come up with an actual capital program to build the project, and that design work is the design of the project, you could then go to the water board and say, we've got a project, here's our design, here's our engineering, here's our feasibility study, and so forth. And they might say, yeah, this is a project that we're willing to support and will loan against. But they're not going to fund the design work for a project that may never happen. I don't think that would really even be, considered a viable application.
Okay, thank you.
Yeah, so just to kind of follow up briefly on the point that Liz made, as you go forward, when you get into the very large expenditures associated with the nutrient removal project, the hundreds of millions of dollars, that's where an SRF loan or potentially in the right circumstances, a WIFIA loan might pay big dividends, a lot of savings, and you'll have ample time to kind of engage in that process and to line that up, to submit your applications and to, kind of refine your approach. So I do agree, those should be considered, first options as you go forward. I'm not sure that they're necessarily alternatives available to you at this time, though. All right, so I'm on the 4th page. We talked about the idea of issuing bonds. The agency has the authority to issue certificates of participation in its own name right now today without going through this whole JPA process. But the market, the investors out there in the marketplace, generally they prefer bonds over certificates of participation for a variety of reasons. And so most issuers in your situation, if they're active and large enough, they generally try to issue bonds rather than certificates of participation. In order to issue bonds, you can either go through this lengthy public approval process. Your member districts each have to approve it. Then the constituents of the agency, the 40,000 customers, would have to actually vote to approve it. It's an impractical process governed by state law and by the TTSA Act that governs the agency. So the sort of the workaround that the state law provides, they created the JPA Act specifically to create this option for agencies such as yourself to form a JPA and then to have the JPA act as a shell, if you will, a conduit to issue the bonds on your behalf. So, and Dave is here actually more well versed in the details of that. If you want to query on the details. No, not now. All right, we'll keep going. So here's some numbers. It kind of lays out for you what's contemplated in terms of the actual details. We talked about $25 million. On the 5th page here. So on the left-hand side, those are the outstanding 2020 bonds that you're currently paying $3 million a year through 26, 27, and fiscal year 28. Then they're gone. At that point, you'll be debt-free. The 26 bonds that are being contemplated, you wouldn't pay any principal on these bonds until after the 2020 bonds are gone. You'd pay some interest in the meantime. And then, once the old bonds are gone and the new bonds are there, you'll be paying about $1,775,000 a year for 20 years. Which is down from $3 million, so about $1.25 million of savings. I don't know if it's savings, it's just less debt service than you're currently bearing. And so, the total is, $1,775,000 starting in a few years, which, given the rate increases that you've recently put in place and the cash flow that you're generating, this is well within your means to afford, it's not going to strain your finances. And it leaves, and, on the next page, you can see, this is just sort of a graphic of what the of what the debt would look like. You know, the three yellow parts, that's your current 2020 bonds, all the interest payments on the 26 bonds, and then beginning in 29 through 2046, that's when you would start paying the principal down. And you can see this kind of leaves room in the future, you know, in a few years from now, if you need to issue more debt, it leaves room to layer on top of this some additional debt. And then in the back end, after 2046, when you have no debt, you can put a lot of the principal that may be coming due in the back end as well. And with an SRF loan, for example, you can defer the repayment of principal until a later date. You have flexibility about when you exactly pay off the principal. So there's a lot of flexibility here on how you structure any future debt issuance that you may have.
Reality on this chart though, Stephen, though, is at some point, we're going to be issuing more debt. So somewhere down the road, it's going to go back up, correct? I just want to make sure I understand that.
The path that you're on right now, it would appear that that's the case. You know, that seems to be the direction that you're headed.
Okay.
This is a great visual. It's a chart that in my past career I have used to visualize to the board what that future capacity is and how it will fill up. So when we go to the next level of this, we'll use this as our base, assuming that we've issued this debt, and we'll use a different color to feather on top of that. Maybe that will show that SRF or WIPIA, or hey, we're going to issue another tranche of bonds, and then we're going to ramp up into that SRF or WIPIA. But this will be a visual that will constantly come back to the board centered around financing conversations.
What we're seeing when the yellow stops is when we pay off the current.
That's the original SRF debt that we have that Stephen was talking about that we took out in 2020. Correct.
Okay.
But we'll add lots more colors. There won't be so much blank space.
It'll be a rainbow.
As we continue, for sure.
Right, and the rate increases that you approved in 2023 and that you implemented in 24, 25, and the next 2 years, you know, those rate increases are going to produce a sufficient amount of revenue to cover the debt that's contemplated. There may need to be some future rate increases in the years ahead, you know, 10, 15% would not be surprising, but you've already done, you know, the lion's share of the work that needs to be done in order to position the agency to carry that debt, you know, into the future. You know, you've taken the big step already.
Dan, did you have a question?
I did, but it was answered. It was
Oh.
related to our current rate structure's ability to cover this debt service, and Stephen just spoke to that.
Perfect.
Our current rate structure did assume that there would be debt issued, and that was the mountains and bar charts that I've shown you all. It was anticipated much earlier, but we thought spending would happen faster on digestion improvement. We're now at that time where the mountains and bars require a little bit of help. We also will be redoing the rate model. We're in talks with HDR right now to get the contract finalized so that we can start taking a look at that and include this debt issuance in it.
Yeah, look, you know, the likelihood is that at some point down the road, you know, there'll be a contract that you'll be presented with for the nutrient removal, you know, project, you know, and it will kind of capture, you know, the totality of what's involved, how much and when and so forth. And concurrent with that whole contracting process, you'll do a rate study, you know, you'll start that rate study early on and anticipate that and kind of make sure that your rate structure is aligned with what the outlays might look like. As I said, you're already not far off. There may need to be some tinkering, but not, you know, wholesale revisions, you know, to the process, to the rate structure. Okay, cost of issuance, you know, it's important for transparency. You know, who's getting paid? How much are they getting paid for a bond issue? You know, that's always a big question. All of these costs of issuance are all contingent upon the completion of the debt issuance. So, you know, if for some reason you change your mind before the, you know, the end of the process and you decide not to go forward, you're not out of pocket anything. As far as the costs go, you know, the bottom line there, $261,000. That's a kind of a typical cost. You know, if this was a 30 or 40 or $50 million bond issue, it'd probably still be about $260,000. If it was a 5 or 10 or $15 million bond issue, maybe a little bit lower, but not a lot. There's a lot of fixed costs involved. You've got the underwriter, you know, they're the bidders, the people who are going to submit the bids to buy your bonds. You know, they're going to get paid. They're going to take a portion of those proceeds for themselves. You know, we estimate, you know, they'll make $63,000. It could be a little bit more, a little bit less, but that's a good, you know, kind of ballpark estimate of what they're going to charge. You know, what they do is they buy your bonds from you, and then they turn around and sell the bonds to all of their customers, their account holders, you know, mutual funds, you know, individual accounts and so forth, and they make a little profit on that whole transaction. The legal services, For both the legal services and for the financial advisor, for the municipal advisor in my role, we did a little comp survey. We looked at all the other bond issues or wastewater revenue bonds that have been sold in California this year, in the below the $100 million range. Looked at all the fees that were paid for bond and disclosure counsel and for municipal advisor on those other transactions. Looked for ones that were roughly similar, and we kind of took those as a guide as to what the what the market was for these types of services, and we tied the fee proposal to those amounts. And then all these other fees and so forth, without getting into all the details, they're all sort of scheduled fees. The rating agency has a schedule, the JPA has a schedule, the trustee has a schedule, your agency counsel will have to perform some services on a schedule and so forth. These are all kind of, boilerplate type things. You just take it or leave it, and we take it.
What's the feasibility?
Yes, thank you. That's a great question. I appreciate that. So, this is something I do on all wastewater revenue bonds and water revenue bonds, throughout, my career. So, when you're issuing AA rated wastewater revenue bonds, part of the process is to put together projections of what your future revenues and expenses are going to be and what your debt service coverage is going to be. How much of that, pledged revenue or net revenue will be available to pay debt service on these bonds? That's your debt service coverage ratio. And that's a big metric that investors look at when they're gauging risk. And what rating agencies look at when they're gauging risk. How much cushion do you have in your revenues to pay the debt? And so for a large agency and a large bond issue and so forth, what we do is we engage the services of a third-party consultant who has a market reputation, a rate analyst, like you would know. These are the firms that go around to all the various agencies and do rate studies for them. And we engage the services of one of those consultants to come in and assess, okay, what do we think the appropriate projection is for your revenues, for your expenses, and for your net revenue. They do this in consultation with the agency, hand in hand. It's a joint effort. But they're the ones who put their name on it in the documents, and they represent that in their professional opinion as an independent firm that does rate studies. This is what we think the likely trajectory is for future revenues and expenses and debt service coverage. They're very conservative and very cautious. Yes.
Do you think that helps the agency to get a better rating? It's
Absolutely.
Like
I know it does.
put it together.
Who puts
Seems like Liz could put it together.
Well, it's a collaborative effort. The consultant works closely with the agency back and forth. Here's what we think. What do you think? We need some information. Let's assess this. Here's what we're assuming. And so at the end of the process, everybody is in agreement. Yeah, we think this is reasonable. The consultant, the feasibility consultant, has a little bit more conservative approach. Well, not more conservative, they just have a conservative approach. One agency or another, maybe more or less, who's to say? But they have a very, a conservative approach, and their credibility in the marketplace is very high, much more so than any individual agency, because they're independent. They're not tied to the agency. And so I've gone to rating agencies many times over, and they have consistently said that they value the independence of the rate consultant doing the projections. We've gotten AA, we did this in 2020, and you've got a AA rating. The agency had never before had rated debt, and we got a AA rating for the agency right out of the box, and I would attribute a lot of that to the work of the consultant that we engaged. I've had clients that have AA plus ratings on their wastewater bonds, AAA ratings on their wastewater revenue bonds. In every case, we've used the consultant to come in and do the projections, and the rating agency has endorsed that approach. And also, they don't really charge that much, relatively speaking, for the role that they're performing, because we try and provide them with all the information, make it an efficient process, so they're not spending inordinate amounts of time. Right. Tell me, do you think that's, are you skeptical?
Yeah.
You are?
Yeah.
I see. All right, well, we'll address that. We'll address that.
So in essence, it sounds like we're paying for the credibility of this.
They're independent.
They're independent.
Yeah.
So that's what.
Yes, you are. And the reason why is that the AA rating, if you were a single A rated, we wouldn't even be having this conversation. It wouldn't be worth it because nobody cares. It's not that important. At the AA rating, the bar is very high. You need to meet certain, credibility criteria at the AA rating that you don't have to worry about if you're a lower rated borrower. But at the AA, the credibility does matter. Everything matters. Okay, a little bit more, hopefully not too much. Oh, some interest rate information. You know, it's important to keep an eye on where interest rates are right now. This is a graph. This is the last 2 years. This is an index. So it's just an index of what the municipal bond market interest rates are for the types of bonds, excuse me, that you're issuing. So you can see back in October of 23, 2 years ago, you know, interest rates were considerably higher than they are today. That was when inflation was still really a big problem. You know, this index was almost at 5%. You know, soon thereafter, inflation started to recede a little bit, and we saw a big drop in interest rates. But then after a while, people started to realize that, you know, inflation isn't going away. It's still a problem, you know, 3% inflation, you know, 3.5% inflation. So interest rates started to become more volatile. They went up, they went down, you know, generally at a reasonably low level compared to the peaks. And then earlier this year in March, there was this whole thing about tariffs, which really rattled the markets quite a bit. There was a big concern that inflation was going to, you know, come back because of these tariffs. So interest rates shot up again, you know, not quite as high, but almost as high. And then ever since then, we've seen rates, you know, it's kind of recede a little bit gradually over time. We're down to 4.21% as of the most recent, you know, reading, you know, which is down a bit from the last few months. Inflation hasn't been as much of a problem. It seems to be, it looks like, you know, we're in a trend of gradually, you know, kind of modestly declining interest rates. It's somewhat favorable. You know, this may continue for a little while longer, you know, or, you know, not, it's hard to say, but, you know, it's nice that we're in a trend of declining rates. And hopefully that will work to your advantage, you know, over the next 60 days or whatever. You know, if we could save another 25 basis points on this, that would probably be the, you know, the best case scenario. And that's kind of what we're looking at. But on the next page, just to give you perspective, this is the same index, but it goes back to 2013. So as you can see, that 4.21 on the far right-hand side where we are today, that's a high interest rate. You know, we're in a favorable trend in a bad market. Right? And it's important not to lose sight of that. You know, we're off the highs, but if you look back before COVID, before inflation became a problem, interest rates were considerably lower for years before then. But now, ever since COVID and the onset of inflation, we're in a much higher interest rate environment. You know, that 421 it's good relative to the worst case scenario, but you know, in the long run, it's not that impressive. You know, it's not that great. You know, if we were 25 or 50 basis points lower than that, that might put us back sort of in the historical, you know, mid-range perhaps. You know, maybe we'll get there, maybe we won't. It's hard to really predict that inflation is going to go away and that rates are going to go back down, you know, given, you know, the national debt that we've got and all. You know, there's a lot of factors that, you know, argue that rates aren't going back down to those levels anytime soon. So yeah, so we're in a good environment now, relatively speaking, but the big picture is it's still a high interest rate environment, you know, by historical standards, and that's not going to change. So it's good to kind of be aware of that. And then the last page, you know, I printed this out. This was the results of the 2020 bond sale. We did a competitive sale, or you did a competitive sale back in 2020. You can see we got about a dozen or so bids. You know, these are the kinds of firms that bid on bonds. Some of these are very familiar names, you know, Bank of America, Citigroup, Morgan Stanley, and so forth. You know, these are the firms that are interested in buying your bonds. They're the ones who are going to look at your documents and look at your agency and look at your debt, look at your capital program, look at your feasibility consultant to see what did they say about your bonds and so forth, and submit bids. And you can see the competitive process is really great. I mean, that's why we do it. You know, they shave their bids. You know, in order to win the bonds, you've got to cut pennies off, you know, the dollar in order to beat out the other 11 firms that are bidding. So, you know, as far as interest rates go, the competitive process is the best tool we have to try and grind down that interest rate as much as possible. I don't have anything more.
Are there questions of the board for Stephen or any questions about JPA or anything for bond counsel before we wrap up?
I don't think so. Dale or Dan?
I don't have any additional questions.
Thank you.
All right, well, as we.
No questions.
Thank you. As I kicked this off, it was an informational item. It was a lot of information. It was a great conversation. I am looking for direction from the board as to whether or not they would like us to move forward with the proposed schedule. Here's what that means for you all. There will be a lofty packet of legal documents that will come to you for approval next month. We'll walk through them, but taking a look prior to it would be very beneficial. Because with that approval, we'll then be able to move out into the market. And as Stephen said, we have that schedule, but your approval in December does not mean we have to actually take action in January. It just gives us the ability when the time is right in the market to do it.
Answer questions.
So a lot more caffeine at the next meeting.
Energy shots for everyone. Don't tempt me with a good time.
So, thank you, Liz.
So we're looking for direction.
Yeah,
Yeah, I
I'm looking
think,
for maybe a yes or a no.
I'm a yes.
yeah, I
Right.
think so.
Absolutely.
All right. Remember that next month when you get the big packet, you might be cursing me when you're looking at all the legalese documents. But we'll also utilize the meeting that you all have independently with the GM to walk you through any individual questions that you have to make sure that everyone's ready to cast their vote.
Thank you, Stephen.
I actually get to sit down now, so thank you all.
Okay, so we have to move on at 10:30. Scott, will you be able to?
I mean, we can start it and see how far we get and they can, I have a consultant with, that's the word.
Take a break
I
and
think,
then go
yeah,
ahead.
that's what I was saying. Why don't we take a break and then come back to the closed session at 10:30? We will now end the closed session and move back into the open session at 10:41 a.m. Josh, I believe you have a report out for us.
I do. The board considered a proposed settlement agreement between the agency and Trevor Shamblin, a former employee, on certain employment claims. The board approved that unanimously, and we are reporting out today that that agreement is final since it has been signed by both parties.
Thank you, Josh.
Thank you.
And with that, we will move to the presentation on the high-strength waste receiving evaluation study findings. Scott?
President Wilson, Scott Point, Senior Engineer and Interim Technical Services Manager. Here today to present the findings from the high strength waste evaluation study. So background, fall a year ago, staff identified that it was a critical time for us to evaluate high strength waste. It's been discussed over the years, but not fully evaluated by a professional engineering consultant. It coincides well with digestion improvements in that the same firm that we engaged to do the high strength waste evaluation is also actively completing digestion improvements final design. So they have a lot of intimate knowledge ongoing with the facilities and our capacities. So economies of scale of already having them spooled up and mobilized to work on that. So we engaged Brown and Caldwell, and they kicked that off last fall, and they've been working on it, and we're here today to basically present those findings to you guys. No action expected. But is it working right now?
Try it.
Doing anything?
I got you.
Thank you. Perfect. Awesome, Dan. Do you want to leave that for you? Yeah. All right, thank you, board. I'm Adam Ross with Brown and Caldwell. I'm the project manager for the digester improvements project. And this is Lexi Valenti. She's our engineer. She'll deliver the majority of the presentation, but I'll set the stage so that you know how the high strength waste project or evaluation interfaces with digestion. So under the digester improvement project scope, which we're in design for right now, new boilers will replace your existing steam boilers, and those boilers provide heat process as well as for the campus heating needs, which is an important function. The primary fuel for the boilers will be your digester gas that you're making as part of the treatment process. That is a free renewable fuel, and it's obviously the preferred choice of fuel that we would supplement that with natural gas as needed. But other than in the coldest months, we actually have more digester gas than what you need for heat. And so without any other solution, you would just flare that gas. We looked at, within the digester project, the opportunity to install some sort of technology to use that extra digester gas, and settled on what's called a linear generator. And so that makes efficient use of your gas, it's low emissions, and would offset a portion of the power that your plant uses. So it's cool. It makes renewable power, it reduces flaring, it adds a renewable energy component to the project, which may allow us to go hunt grants as the project develops. Now, the reason it sets up high strength waste is because that linear generator has more capacity than what you have digester gas. So you have enough to make it feasible, but more would be better. High strength waste would make more digester gas, and now Lexi will explain all the evaluation behind it.
Yeah, hi, like Adam said, I'm Lexi, I'm Veronica Caldwell, and I'm one of our engineers. And so it's talk about really cool stuff. So essentially high strength waste, we'll talk more about exactly what it is in a couple of minutes, but you bring in high strength waste to your plant. It generates more biogas. We'll use that biogas in your boilers first to heat for your plant heating and your digester heating. And then any of that excess gas will go to the linear generator. The linear generator produces electricity, and then we'll allow self-generation. We'll offset some purchase electricity. Oh gosh, they got really small. Let me scroll on here. So, what exactly is high strength waste? High strength waste is different from the municipal sludge coming into the plant. So the municipal sludge is essentially what's coming and being collected from your sewer. High strength waste is other types of waste that can be collected around from your collection system. So essentially, it's we want it to be liquid and pumpable and free of inorganic contamination. And ideally, what we really identified in the area that has the most, that is most available is something we call FOG, which is fat, oils, and greases. And this is essentially material collected from grease traps at restaurants. This is the stuff we don't want in our sewers. So it's basically any material that gets separated from our sewers. So it's stuff too strong to be discharged into our sewer, and it's hauled to the water reclamation plant and fed directly into our digesters. And this material is more energetic. So because it hasn't gone through any wastewater process, because most of the solids going into our digesters is stuff that's already been treated and doesn't have as much energy to it. This is like basically raw material that has a ton of more energy. So this is where we're getting more of this gas from. And so at the end of the day, again, like I said, this basically bringing in this excess material result in more digester gas. Other types of high strength waste out there are things like brewery waste. The breweries produce a waste product that has to get treated elsewhere or discharged to sewer. Another source is potentially food waste, but with food waste, there is a source of food waste in your area. The only problem with it is we want it to be processed before it comes into the plant, and there's kind of this disconnect right now in the food waste community where there's not really somebody doing that pre-processing. So again, that brings it back to like, if you want stuff that's pumpable and liquid and easy to handle coming on site, that's not going to be a headache. And essentially it meets all these different criteria. And so part of this evaluation is we had 4 big questions we wanted to answer. We first wanted to answer how much high strength waste does it take to max out the linear generator? How much do your digesters have the capacity for these additional feedstocks? So essentially, your digester and your equipment has capacity limitations to it. And the primary point of the plant is to treat municipal sludge wastewater. So we don't want to bring excess material in that's going to push you beyond your sense of capacity boundaries. So there is kind of this nexus here. And then there's the other question, is there high strength waste in the region that we could bring into the plant? And then combining waste together, can this high strength waste program be implemented at a tipping fee that provides a return on investment that is attractive to the high strength waste haulers? So the idea is you would be able to actually charge a tipping fee, essentially $1 per gallon coming into the plant to these high strength waste haulers to actually generate a little more revenue besides just any additional electricity offset you're getting. So the high strength waste evaluation goals, the idea was to analyze the feasibility of establishing this program here and then determine that minimum amount of high strength waste we need to bring into the plant to receive a payback over 20 years for the linear generator. And determining like if the tipping fee is needed to kind of push that payback period. And we wanted to identify high strength waste sources, and then we evaluated the cell's process capacity. So essentially took all those questions and we were trying to achieve all these goals together. And right now I'm going to walk through essentially how we answered each of these questions. So first is how much high strength waste does it take to max out that linear generator? So there's the red bar kind of represents the amount of specific volume of high strength waste required to produce enough energy that will basically have the linear generating 24/7 all times of the year. And there's some downtime and maintenance period built into this, but essentially this is the amount of volume you need to get the linear generator going and going year round. Next is the existing digester capacity that you have, and we projected this out to 2045. And this is basically how much volume you could take in without pushing past your existing digesters capacity boundaries. Next question is there even enough high strength waste in the region to meet these, this criteria? And so we talked to a handful of groups. Reno Rendering is the existing fog collection that drives around and takes all the grease out of the fog traps from restaurants in the area. There's potential brewery waste in the area and potentially future food waste if that connection between like the food waste collections and like pre-processing can happen. But essentially the dotted blue bar is outlining like the potential amount of volume total. And then that dark blue bar is what we've identified with Reno Rendering, what fog is willing to divert here instead of bringing it to the rendering site.
Excuse me, did you say they would be willing to?
Yeah, we've had conversations with them. And they're kind of at a point right now in their business where they're hitting some capacity issues, and they, and answers for them is to either build more infrastructure or potentially, instead of having to bring fog to their facility to handle, it could go to a local place like GTSA and be utilized to make biogas. There's some ongoing conversation with them, and they're pretty responsive and excited about it. So,
Okay.
Yeah.
So there could be potentially coming from Reno to us?
No, it would be your fog in this area from your restaurants, and they're the contracted hauler
Right.
that's coming from Reno and collecting your fog. So instead of having to drive back down to Reno to their facility, they would collect the fog in this local area, bring it here.
Okay.
So that's like
Okay, I thought I heard that you said they're gonna reach capacity and looking for other.
it's more their facility down in Reno, but they can offset some of the material going into their plant by bringing it here instead and keeping it here local in the area rather than shipping it Reno. Yeah. And so then that fourth question, can a high strength waste program be implemented at a tipping fee that provides a return on the investment for the linear generator and the high strength waste receiving facility itself that is attractive to these haulers? And so like this floating green bar, thank you. This floating green bar is kind of like this intersection point where, yes, if the program is established, this is kind of that volume that you would need that would pass an inflection point in the amount of volume you need at the tipping fee that you could implement that also aligns with how much high strength waste is available. And so this kind of summarizes this, like, we're trying to fit into this operating range of optimal high strength waste volumes where the target volume of high strength waste is available. It's within your process capacity limits, and it's also within your linear generator capacity limits. And so at the end of the day, we're kind of meeting all of our objectives, and it makes sense to move forward with this high strength waste receiving program as we can connect all these different dots. And so to summarize, the digester capacity is sufficient to accept the high strength waste, and the high strength waste will allow for sufficient gas production to max out your energy recovery potential associated with the linear generator. Thank you. This will reduce, it's like a computer being when things move. And then high strength waste volumes and tipping fees required to offset your investment align with what's available in the area. And then our recommendation coming out of this evaluation was to reach agreements with local haulers, maybe specifically Reno Rendering or other breweries or anything else, to receive a minimum of 3,000 gallons per day of high strength waste and up to 10,000 gallons per day of high strength waste. And so like this is kind of that range of high strength waste that keeps you consistently producing electricity, which will then offset your investment in the linear generator itself, and also the high strength waste receiving station you have to build in order to accept this waste. Lot. Thank you. We'll take questions.
So this is a build it and they will come methodology.
It can be, and part of it is by having this communication, like talking to Reno Rendering and talking to haulers first, you can identify and understand like waste is in the area and they want to come, and you can set up some like letters of intent and just have like the basis of knowing there is the waste there, and then you can build the infrastructure and they will come. I mean, other facilities have like had very specific like contracts with haulers and they build the site specifically for them. There's different ways to go about it, but predominantly is if you build it, you will have, I think, like knocking at your door.
Isn't it also true that having this renewable source of electricity, that there is a federal program that you can receive a 50% credit back for that? Yeah, or construction costs.
Yeah, so
The equipment itself, so I think that's true.
it's the, from the Inflation Reduction Act. Yeah, so I'll let Adam, Adam's our IRA guru who knows all of ins and outs of it.
Yes. Yeah, the Inflation Reduction Act added to the investment tax credit program that would give you a kickback if you did solar on your house or if you will sell other things. It added biogas as an eligible technology, and it allowed tax exempt agencies like TTSA to be able to get the tax credit in the form of direct payment. The linear generator is actually eligible under the umbrella of fuel cell technology. And you can get either 30, 40, or 50% credit based on different factors. We would probably get the 30%. And that's something you can't change. It's just based on your location and project type. But yes, you do the project, you document your costs. When you're done, you file a tax return and then get a check back in the mail for 30% of your eligible costs.
And it's real. We have a plant that just got a check.
Yeah, just got, City of Roseville had been farther along on the project. We let them know about the opportunity. We submitted, crossed our fingers, waited like a year, and they just got a $32 million check from the IRS, which feels real good.
Wow.
Yeah.
Take it.
Yeah.
It's like a win-win to me.
Reduce the greenhouse gas.
Thank you.
Thank you very much.
So, yeah, I think the next steps for staff is we're going to continue to pursue conversations with Reno Rendering, see if there's anything more in place for letters of interest or memorandum of understanding. At this time, we don't have anything on the CIP planned as of right now for any log receiving stations, which would be like the next infrastructure step required. But the current plans are next month to come back to the board, assuming we can get the contract terms in place with our legal group and Mainspring to present to the board a recommendation to go into contract with Mainspring for the linear generator for the project. And this would be the first time the agency's pursued a pre-purchase, pre-selection of equipment. It is a patented technology, so we're currently negotiating contract terms with them. So the goal is next month or January, come back to the board with those recommendations if we can get mutually agreeable terms. So not going to do the cart before the horse here and commit to doing log receiving before we even know if we're going to be putting that technology in. So, and I think Director Wilkins, who has his hand up over there, has previously asked about that check-in point. So we do intend to come back to talk about the Mainspring generator at the board meeting.
Okay.
I don't know if Director Wilkins.
Yeah, Dan, I see your hand up.
Yeah, thank you. The, so assuming we install the linear generator, currently the gas produced at the plant would only have that generator operating part-time. If we started incorporating high-strength waste into our waste stream, we would be generating more gas to run the generator more frequently. Is that how that would work, Scott?
Yeah, Director Wilkins, that is correct. So seasonally, summertime, they have excess gas and we typically have been flaring it off historically. But in the wintertime, with heat demand up for the digesters as well as our comfort heating needs for the facilities here, we kind of have a shortfall of digester gas. So we supplement our boilers currently with fuel oil or diesel. So the goal would be that if we could also get fog in wintertime, it would boost up that gas production to the point where we would be running both boilers more frequently on digester gas, but also through this linear generator. And I think, Lexi or Adam talk a little more about the payback, Director Wilkins, if you have more specific questions about the terms, the duration.
Yeah, I mean, we looked at everything so that each piece pays back as an individual component. So we evaluated the linear generator with your currently available digester gas. And we also looked at the ability to augment with natural gas as needed, as a backstop. Ideally, we prefer to run on the free renewable fuel. And so that's where the high strength waste evaluation says, okay, given that you're doing boilers, a gas storing cover, linear generator, how does high strength waste fit in? And it makes everything better. So that's but we did approach it in the appropriate sequence of covering the process, covering the fuel, and then, increasing.
Okay, thank you.
Dale, any questions?
No questions.
Gassed up, we're good.
You're well.
All gassed up, we're good.
Thank you.
Thank you, sir. Look forward to further information. With that, we will now move into department reports. Oh, we
The, employee performance evaluation system.
Oh, yes. There, now.
All right. So, some of you, might remember when we implemented Comp and Class, this last summer, there was a implementation packet that was included with it. Had a lot of details, but a few of those details that were specifically relevant to my directive was, a commitment to evaluate the evaluation system, modify it so that it incorporates the guiding principles that we adopted last year. And also, it was noted in the implementation that the current non-base pay performance incentive would be sunsetted on December 31st, 2025, unless the GM felt there was a reason to not do that. So I've taken a very close look at it. I've had several meetings with the core group of supervisors and managers. And my main question for them was, do you, as a supervisor, see a benefit in the form of a tool that you can use to encourage high-quality employees using the incentive program? And I got a resounding yes from the supervisors. Part of that discussion then precipitated some of the specific issues that employees and supervisors had with our existing evaluation system. Namely, on that list was specificity. The rating is very vague. Let me first acknowledge an evaluation is objectifying a very subjective thing. So we're putting a number on something that is someone's subjective opinion. Every step we can take to further objectify that and make it more tangible is a good one. It's a challenge. So with feedback from the supervisors and some of my experience from the past life, I made modifications to the evaluation system that better, in my opinion, defined how each of the scores is assessed and provided. So it's difficult to, you can look through the packet, but I'll just summarize. Effectively, a 3 is you're coming to work, you're doing your job, you're meeting the requirements. You have not impressed me, but you have not caused any problems either, right? That really doesn't need any justification. That is what it is. It's a 3. If a supervisor wants to award a 4 in any category, my expectation under the new policy is I want to have 2 specific examples of how that person provided an exceeding of that particular category. So any of the core values or any immediate job functions. with the caveat that the employee also has the opportunity to go into the evaluation system and make notes throughout the year. If they believe that they have done something that warrants some notice, they are free to go in and provide that and make their supervisor's job very easy. And I support that. And so with this, I think there was a lot of staff that were happy to hear that there was an objective goal. If I achieve these two things during the course of a year, I can get a 4 in this category. A 5 is 3 specific examples, and I want one of those examples to specifically demonstrate how that person has impacted the culture in the way that they have impacted those around them, encouraged others to have a positive outlook, encouraged others to take responsibility for their work, those kinds of things. So the bar is very high, and that's good. I support that. The other end of this is the below expectations, the below 3. So if you're at a 2, I want to see specifically, I want to see communications between the supervisor and the employee, documented conversations. And I've communicated they can use email to do that. That's fine. But I want to see what the problem was, evidence that it was discussed with the employee, and evidence that they were provided with a clear path towards improvement. And if that does not meet, then there is a justification for a 2, but I want to see that documentation. So all the evaluations go through me at some point or another and through Vicky. The 2 of us can screen those things to say, okay, I support this supervisor's decision based on. And we've already provided a bunch of training for the supervisors, and we're going to do recurring training. And I've also provided this information to the staff at an all hands meeting and let them know that I would be bringing it to the board. The unacceptable, the one is bad. So I want to see documentation of disciplinary action. And I want to see if there's a plan of improvement. I want to see the evidence that there is a tracking of that process. I want to see that there's engagement from the supervisor and the employee, that it is not simply a lost cause. But if we've gotten to the point where an employee or a supervisor is thinking of giving an employee a 1 on their evaluation in any category, I need to see some substantial documentation. So we've kind of codified it as much as we can. And I've also made a commitment to staff that we'll take a look at this system on an annual basis, look at what kinds of scores we're seeing, look at what kinds of, is there a good consensus amongst supervisors that what things constitute high or low? And we will continue to refine this and continue to provide training. So it's going to have to be a very, very organic, ongoing process. But my contribution to this primarily is the specificity in the number of instances and the expectation that the employee has to have a little bit of the onus on providing that information to their supervisor. I might have at one point said something along the lines of, please do not expect your supervisor to follow you around and expect full stars to fall out of your pocket. You need to broadcast that information to your supervisor. If you feel that you went above and beyond, please communicate that to your supervisor. So we've had those conversations. It seems like it's relatively well received, but again, we'll continue to monitor on an annual basis, get out some surveys, ask employees, have they felt that the new system has been beneficial, those kinds of things. And then associated with this is the non-paid incentive. What I've got on the screen is a representation of the categories as they exist today. And will expire on December 31st without action. So my main concern with this system is that you can get it below a 3 and still get an incentive. And I think that we can do better. So my new system eliminates getting a bonus for getting below satisfactory. It just is what it is. But again, this lump sum system, there's been a lot of, I think people have appreciated it. I don't believe that the employees don't appreciate it, but there's been a lot of criticisms about, well, how do you get to that 4 to 5% bonus? What kinds of things, there's jokes, do you have to walk on water in order to get these kinds of scores? And hence some of my objectification of the scoring system so that it's attainable effectively. But what I've come up with is this system here, which is effectively anything below a 3.5, you don't get an incentive. There's no incentive associated with below 3.5. between 3.5 and 4.5, it's a prorated amount from 0 to 5%. And I know I've explained that several times to people, and for some reason it makes really amazing sense in my brain, but I can understand how it is not completely intuitive. But effectively, if you were to get a 4, which is dead in the middle of the system, you'd get half of the bonus, which is 2.5. This system can potentially allow for, if you got a 3.52, yes, not going to result in a very large bonus. It's not going to result in much. But I believe, based on having looked at the scores from the past couple of years, I believe that a 4.4, 4.5 is attainable. You're going to do a lot of extra work to get it, but it's a 5% incentive. I think it's substantially warranted, a lot of substantiation. So my proposal is basically that. And it's not going to change from the lump sum. We have to do that. And again, eligibility for this is if the employee is currently maxed out. Questions?
Yeah, could you give me a little bit of understanding on the steps? And so this number 1, the revised employee evaluation system, that is for all employees regardless what step you're on currently, correct?
No.
Okay.
But yes, I'm sorry.
Okay, so then, and then what is the decision point to go from one step to another step?
Currently, and something I would also consider revising is, but currently, I believe it's 2.5 or higher is the evaluation in order to be qualified for a step. I would consider revising that to 3.
Yeah, I was just trying to understand if that's sort of a merit performance-based type of criteria going from step to step, or if it's some kind of automatic thing that you get if you've been in that position for a certain time frame. I'm just trying to get an understanding of how the step process works. So what you're saying is if you have currently a 2.5 or higher in your performance evaluation, that would push you into another step.
Correct.
Okay, thank you.
How often during the year are there reviews to this?
Annual is the only documented review, but obviously we encourage very regular check-ins with employees.
So I would think that there should be
Yes.
quarterly. I mean, for me, it's complicated. And as an employee, it's like, if I'm at 2.5 and I think I've done 2 things to, it was a impact culture and others around them. I would want to know if just because I thought that and it happened in November, that was actually one.
Yep.
This seems to me, I understand where it's going, but it seems a little confusing. I mean,
Well, here's the truth of any evaluation is that it should not be a surprise. Nothing in your evaluation.
that's why you want to do.
Good, bad, or, yeah, correct. Good, bad, or indifferent. And legally, there's a very high bar for anything negative.
Yeah.
Things can't just show up in an evaluation that are negative without some pretty substantial work done in front. I would argue the same is true of positive. But again, I think at this stage, we're working with the supervisors to provide training. The feedback from them has been, some of them have a handful of employees, some of them have a large group. But committing to a quarterly update with employees, for some is totally doable. For others, it might be more challenging. But they all do agree that there should be a pretty regular conversation, even if it's a 15-minute conversation. I mean, part of the problem with any evaluation system, and I think it's part of public sector life, quite honestly, is that this whole thing has a tendency to go into introvert mode and let's just forget about these. And then when you have a problem employee, there's no evaluation record of that problem employee. And when you have a stellar employee, you remember their evaluation the month before it's due and you go, oh, I better put this together real quick. So unfortunately, we are compelled to do these. And unfortunately, I don't think the industry, the public sector historically has done a very good job at them. And so I think it is a very important point to focus on. And, you know, like you mentioned, it can be confusing, but the intent would be that the relationship between the supervisor and the employees is solid enough that they're communicating regularly. Now, formatting that, definitely feasible.
And the documentation is critical.
Yeah, completely. So I think dance.
Dan?
Oh, sorry, Bert.
Sorry.
Keep that hand up.
Yeah. Yeah, thank you. So Jason, the non-base pay compensation only is awarded to employees who are at the top of their range, correct?
Correct.
So it's when an employee is work. So if you come in at the bottom of the range, you know, each year you get an additional 5% as long as you your evaluation has you at a 2.5 or better. When you get to the top of the range, there's no more room for salary increase other than through COLA adjustment each year. And this is monetary incentive for basically a bonus for those employees. So the kind of responding to Scott's comment about this being confusing, I think I get it. I think the what could be done to make it a little simpler would be to take the formula. It's the second bullet, you know, the 5% times 4 minus 3.5, and kind of break it down to, okay, if you get a 3.5, that equals, you know, 0% raise. If you get a 3.6, it equals, or bonus,
Yeah.
3.6 equals, you know, X, 3.7 equals Y,
Yeah.
et cetera. That would just basically do it math as part of the system here.
Yeah.
So that might help a little bit. Another thing that you could consider as part of the evaluation process is an opportunity for employees to do self-evaluations that they provide to the supervisor.
Yeah, that's part. Yeah, that's part of the system currently.
It is, okay.
Yeah.
All right, great.
Which you're right. That I think part of the discussion we had with the supervisors and the staff was a realization for some how important that self-evaluation is going to end up becoming into this system.
Yeah. Okay. Good. I am supportive of continuing to provide monetary incentive for employees that are at the top of their range to continue performing at a high level. So I think, you know, these systems are never going to be perfect, but I think the goal is appropriate.
Okay. Thank you, Dan.
Yeah, so I appreciate the enhancements and all that. I think those are heading in the right direction. After listening to this conversation and the conversation we had yesterday, it seems to me that we're just moving through the levels too fast. That's why we have so many people at the top of the range. I don't understand why somebody is a 2.5, which is below expectations, would get a move to the next level. That doesn't make any sense to me. If we're talking about performance in that, you know, we pay for performance, then that part of the mechanism probably needs a look at. Because it sounds like at the end of 6 years, everybody's at the max. That doesn't sound right for some.
Could be even less if they came in at a higher step too.
Okay, so that's kind of my personal view on this. We're attacking it from the wrong angle.
Yeah,
I think. But I'm not good at what you guys have been doing internally forever, so it may be fun.
I would say, so part of this process, there's this portion that I've presented to you. There's the other half of the portion, which is what you just described, which, given your feedback today, I might incorporate for what I bring in December, which is number one, what is the criteria for getting your step raise? And I think the argument could be made 2.5 is too low. So yes. But again, where is that number? I would think a 3 is appropriate, but that's not likely to change a ton of that pacing. But I agree. The other half of that,
What does a normal step change increase look like?
it's 5%.
It's 5
Yeah.
instead of a COLA. So we're talking 1.5% maybe, or 2 points at the most.
Well, no, it's 5% on top of COLA.
Oh, on
If
top.
they move into a different step, the COLA affects all of the steps and all of the
I
races.
see.
But again, the other part is, should you get the raise? But the other part of that question is, if you're knocking it out of the park and you're not maxed out, is should there be an opportunity for multiple steps?
That makes sense too. That would
Yeah.
all be around performance-based comp,
Fair enough. That's good. Good.
I think. Let the rest of the board chime in.
I agree. I agree. And I would like to see a couple of examples,
Sure.
just that would help.
Yeah.
So maybe.
Yeah, we take for granted sometimes having lived in these universes for multiple decades. You know, a lot of this stuff it's kind of built into that public sector mentality. So
And I do have one concern that you touched on. The supervisor that has a large number of people. It's gonna be a bit of a burden. Right? Have to do Evaluations on 10 or 12 people.
So I will say this, I'm not a big advocate of working supervisors, and that sounds contradictory because a working supervisor is the ultimate in flexibility, right? They can supervise and they can go do the job, which yes, all supervisors should be able to do the job. But what is their focus? If their focus is managing performance, providing training, providing, support to their employees, you start adding all those things up, those to a full-time job, doing it really well is a very taxing and it's a high value proposition for them to get paid more because they're responsible for the performance of other people. So it's a difficult dynamic because I don't necessarily, I tend to lean towards a supervising supervisor. And if you're talking about, hey, I want you to do quarterly check-ins, a working supervisor might be tasked where they're gonna say, I don't have time to do that. I've got 7 employees and I do portions of the work. I don't have time for this. So that has been a discussion we've had with staff and supervisors as well, which is, how do we supervise? It's a tough question, but, and it's a philosophical, I believe, leads to the culture of the agency, so duly noted.
Okay. Further questions, comments from the board?
Just one comment that I appreciate, Jason, that you have included in this proposed new rating, demonstrating cultural impact, being in that outstanding rating category. I do think that is something that, will help steer the agency in a good direction. So, thank you.
And just keep in mind, what I bring you in December is going to be a wordy, lengthy policy document. This is a summary of that. We will incorporate tables and examples, as Dan mentioned, probably to make it a little more digestible for you and the employees, but it will come in a several-page policy. I'll try to highlight the changes that were made. I'll incorporate some of the input from today.
Okay. Thank you.
Now we can move on to the end of the reports.
Morning, Board of Directors, Mike Leak, Operations Department Manager. For the November report, we met all our waste discharge requirements for the month. We did the iron sponge repair and also media replacement. We inspected and troubleshot did some troubleshooting on effluent filter number 3. Lime slurry tank cleaning, acid washed, inspected. order of pipe verification for the digester improvement project that you heard about earlier today. And we cleaned and inspected centrifuge feed tank with centrifuge tanks. See our compliance, some of our compliance numbers here. Flows were pretty low as far as, we didn't have a lot of wet weather for last month, so, we had pretty low flows. Just go over time. So filter number 3, we've been losing some extra media out of that filter and more media than normal than we would expect. We always lose some media. So we did some troubleshooting, and can you go through? Can you play the video? Sure. So some of the troubleshooting process we found in some of the surface water piping. We found that some of the surface wash piping actually had corroded. So that water that was flowing out of there was not supposed to be flowing out of that area of the pipe. So we're going to be replacing that piping and fixing that. And hopefully that'll alleviate that media loss, that extra media loss that we have out of that filter. This was the centrifuge feed tank cleaning. Staff were cleaned it all out, acid washed it, made it all nice and pretty for the next 6 months. You see some of the material that gets caught up on the mixer in there that we have to get off. It does, doesn't it? Spooky. We use the Vector truck to go in and clean it. Any questions for the operations department report?
Thank you, Mike.
More video, right?
Watching Scott jump is awesome.
That would be the worst.
I felt dramatic. I was expecting more.
Good morning, board. Paul Schaus, maintenance manager. For those of you that don't know me.
I've been wondering.
Yeah. Few of the projects, you'll see these pretty much on an ongoing basis. Digestion improvements, that's gonna be on there for quite some time. Obviously, nutrient removal project, you're gonna see those on there for the next several years. The redundant server project is ongoing now with our SCADA team. We're also doing, working with engineering on the SCADA upgrade project as well. And we did provide support for the TRI lining project, which I'm sure Scott will talk a little bit more about that. A couple of the notable items that we did work on over the month. We installed a rebuilt MPPS vertical turbine motor. That's a multi-purpose pumping station, by the way. So all the acronyms. We also removed the iron sponge from the digester building roof for rebuild. We got some pictures of that. We had to bring in a crane just to get that thing down. So we just affect the repair. So that's always fun. We can bring the crane in. We installed a new skimmer arm assembly on primary clarifier number 2. Couple other items. We rebuilt a 2-water pump. And also we are working on one of the filters that operations noted. They got that video for us. So we're actively working on that, and we'll have some updated information on that later on this month as we get those parts in and figure out how we're going to get this thing repaired. Good times. We also performed our semi-annual hot and flow study and calibration. We bring in an independent contractor twice per year to go out and calibrate our sites, and engineer stamps that and says, hey, we're calibrated and everything you show is actually your recording. And then we completed a modulating controller installation for a 2-water pond level control. I'm sure you noticed at the entrance of the plant, we've got that pond that was out there. It was empty for quite some time. Now it's back up and running, and we made some improvements to that system. So it's not just an open closed system anymore. Now it bases it on the level and it modulates that controller, so it's more accurate. It stays, it's a little bit less wear and tear on the system. So. And we did attend the training on the Viva and Rockwell platforms. Our SCADA teams did that. And currently we have one active recruitment for the SCADA specialist. We have some interviews scheduled for December.
So hopefully we get a candidate for that and get that approved. So work orders for the month, they were pretty flat. Nothing new there. We actually took a chunk out of the pending work orders a little bit over the month, but the PMs keep coming out and we're adding more PMs constantly. So we actually want that number of PMs to grow. So that's the goal. Couple of pictures for you. There's one of our newer staff members working on the two-water pond modulating control conversion. And there's our big crane bringing in the multi-purpose pumping station motor. Had to drop that in through the roof. So that's kind of fun. You can see the completed product there on the left-hand side. And on the right, that's our iron sponge system there. So we had to get that down onto the ground to do the work, get inside of it and do some welding on it. That was a lot of fun.
Sounds like a super.
It was fun. Yeah. So on the left-hand side there, you can see more pictures of the crane. And on the right there is our primary clarifier number 2. That was pulled down so we could get that done, get that skimmer arm in there. We're going through a lot of those primaries and replacing those clarifier arms. They do wear out. They're pretty old. I think that may be the last or second to the last of the primary skimmer arms. Any questions? Happy to answer.
See, thank you.
Thank you. So,
Morning again, board. So Wilson, Scott Fleming, senior engineer and interim technical services manager to present the technical services department report for you guys today. Ongoing work with digestion improvements. It's a chance to meet some of the VC team working on that for us. As I previously mentioned, we're working on some critical path items, but needed for the project and getting those contracts in place. High strength waste receiving evaluation. VC just presented that to you and next steps we discussed. So time there. The TRI rehab project, we have some punch list items that are going to roll over the next spring. Work is substantially complete. We're awaiting the contractor sends out for third-party testing results for the actual liner itself that got installed. So until that is received, we can't pay out for that liner yet. So we're awaiting those third-party lab test results. And then there's some seal coating work for Taos City PD that needs to occur next spring when temperatures are in range. And then as far as nutrient removal improvements project goes, we hosted the kickoff meetings for architectural and public outreach. Rad consultants that are able to join up here to help us with that large lift. Site investigations, including geotechnical test pits, borings, topographic surveys, biometric and cultural surveys are complete prior to winter. Ongoing data collection work is occurring, and we have camps and workshops planned for 2026. Some of you fine folks that are interested. 2025 digital scanning of sewer lines work is complete. We reviewed the deliverable and reviewed it and are in the process of closing that out. Michelle just filed a notice of completion with Chatham County, and we will start the taker once it's been reported with them. Next slide, moving on to the laboratory. Completed our quarterly pretreatment sampling and annual sampling. There's ongoing proficiency testing, and like every month, continuing California Department of Public Health COVID sampling at cost. And then we had a kickoff meeting regarding the lab as we budgeted this year for lab improvements, but are holding while we discuss with Corolla opportunities for evaluation for the long-term direction of the lab that is in desperate need of rehabilitation. As far as information technology goes, IT completed 23 tickets this past month. They went through the process of relocating to a new office. Luke, who was up here earlier, attended Logicon IT conference in Columbus, Ohio, which I did a couple photos for. It was a very productive informational meeting. You got to meet with different professional consultants in the industry and watch presenters. A great takeaway from it. Very static, get going. They're already looking for additional conferences to go to for next year. They had their monthly roundtable with Tahoe area IT professionals. And then they've been having bi-weekly coordination meetings with E&I regarding the splitting up of those departments. And they're working on currently DocuSign for a lot of different processes around the agency that will help out administration as well as engineering. Permit portal, he discussed, you guys approved that replacement. And then sonic wall, firewall, mitigation work, network storage upgrade commissioning, and security upgrades for Windows 10 for all agency machines. Working on a secondary internet service provider with Optimum. You might see if you're over near our break room, basically a fiber optic cable signaling point over there where they routed that cable through. And then the Verizon wireless account got switched, which resulted in some state and local government pricing savings for us. Photos here, they do basically a seismic evaluation at the plant. So the upper left one there is them setting up the CAD equipment with those receivers. And then the bottom right is one of the test pits that they were digging for the facility for that nutrient removal improvements project. And then this is just a couple of photos that Luke pulled from the website for the conference he encountered. His personal. That's all I got. Any questions?
Yeah, just one, I'm sorry about attention. You had mentioned with the nutrient removal project, having RID consultants doing public outreach. Did you say that they already done some or that it's planned?
So they did a kickoff meeting so far, and then they provided us their strategy document for us to start reviewing, but they haven't really engaged. We've already had a follow-up from Moonshine Geek interested in getting a project update on the status of it, but we haven't started that campaign. They're going to be developing a website, flyers and mailers and informationals to the public and all the member districts. And so they're just kind of making sure that they have a vision first of all. So it's just step one. Yeah, it's exciting. So there. And
If you have name ideas for the public facing project, we're all ears.
so nutrient removal improvements project, while it's near and dear to everyone in the room, it's kind of a mouthful to say with the public. So a lot of these projects that are of this size and scale will have like a public interfacing project name. That's a landing for it. So Pure Water Project or Echo Water for Sac Regionals project. So we basically left the door wide open for them to consider branding and all that project. So as much as like financial documents may still say nutrient improvements project, per bonds and et cetera, for public outreach, it's a lot easier if we can make it something. If you have any ideas, please. No, naming is not our strong suit, so. Any other questions? Thank you.
Thank you, Scott.
In case you were missing me, I'm back. All right, always save the best for last, right? You want to go to the next slide? So from the administrative side of the house, I will note that for the risk and safety, it does say on the report that we were remaining open for the position and that we were conducting interviews. I'm happy to report that an offer has been extended and that they're in the background check process, so more to come on that one. From the finance side of the house, the highlights, I will skip over some of our general duties. We took part in the Truckee Tahoe Area Government Finance Leaders Lunch. That's a mouthful. I also volunteered us to host in the next quarter. They were interested in a plant tour and a few other things. So early in the calendar year, we'll be hosting that here. We also conducted Cassell training. Again, Cassell is our financial information system. There is an Excel-based expense analytical tool that could be used. And so we set up training for that and we held that with the supervisor so they could dig into their budget to actual expenditures a little bit more, so we could have more robust conversations about projections. We also participated in a software demonstration to evaluate the next steps for electronic signatures. It's almost here, you guys. So excited. On the billing and customer service side, as you saw earlier in the monthly financials, we collected about $118,000 in fees. The biggest one here is that we attended the End Project Public Outreach Kickoff. From a customer service standpoint, I have asked Celeste to take the lead from our team being a part of that team. And mainly we're just going to try to come up with a better name. I think the boys came up with it, right? So thank you for your participation in that. On the purchasing and administration side, I'd like to give a shout out to Kevin. Kevin handles his daily responsibilities of the front desk and purchasing as expected, but he always is willing to do a little extra for me. When I can't find a PO or I need a PO done or I need a little additional help on the safety room, Kevin jumped right in to help. So I wanted to put out an extra thank you to him in this meeting for that. Overall, we performed various administrative duties at the pleasure of the general manager and as requested by the board. That's my report for the month. Are there additional questions on any of the documents in the packet?
Oh, thank you.
Short and sweet.
And thank you, Celeste and Kevin.
All right, good morning again, board. So I'm gonna go ahead and cover my stuff. Hopefully don't duplicate. One of the specific things I want to get feedback from the board on is at one point, there was a request to have an ongoing, update on NRIP, whatever we end up calling that. And I believe Scott does a pretty foundational job of giving you guys the information. If you feel that there is a better opportunity for me to expound on that and carve time during the regular agenda to provide updates on that, maybe even on an as needed basis, please let me know. We love talking about this stuff, so it doesn't bother me. So this month, normal board meetings, committee meetings, I've been getting my feet wet, going out and meeting all the general managers in the area. Been a really great experience. Everyone's really, really great. They've been all warmly receiving me, so I really appreciate all of that. Land use ad hoc, I have an update on that has happened since this was printed. So I had a meeting yesterday. I believe 18 or 19 people from various agencies in the area participated, and effectively it was an opportunity for me to sit down, as I had mentioned to the board I was planning on doing, give them a perspective on what the limitations are that we're dealing with, the expectations that we have, the constraints that we're dealing with, and the concerns that we have that make us not want to jump both feet in immediately. There was a lot of really good feedback in that meeting. I get a good feeling that we're going to have an opportunity to work as a community to identify solutions to all of the little problems that have surfaced. There are still maybe four different agencies that have expressed interest in moving forward. So I believe the board is already aware of all of those. So nothing changed there. We will at some point have to take the first steps on some of these that are a little bit further along. So those conversations will likely be happening first quarter of next year. And hopefully we can create a good, safe path forward that incorporates all the concerns, and we're not doing the wrong things with our property, and we're offsetting some expense. So that would be great. Again, as Scott mentioned, we did the public outreach strategic meeting for NRIP. Very cool. Not a headspace that I live in often. I go out and I communicate with the public, but they've been doing this for a long time, and they've experienced goods and bads associated with the project, so they have a lot of really good advice for us. All the other projects kind of continue. We are continuing having every other month all staff meetings. That will be next December likely. So seems staff is here. I feel like they've been enjoying themselves. They look very engaged and involved. There were some conferences and trainings and public outreach events that we attended. Rochelle attended CSDA for conference. This is Sarah Rosa.
Yes.
So that she's got good reports on that. That was great.
It's also several other member district clerks also.
We participated in a big truck day, as we mentioned last time. We've already got an update on the recruitment for the safety and compliance administrator. We had our second interview, so as Liz mentioned, we made an offer. It was great. I did make a presentation at North Tahoe PUD. Thank you, Scott, for the invitation, and please extend my thanks to the board for their willingness to hear our story and what's going on. And they got an update on the NRIP project, and they got an update on the land surfacing situation. So seemed like it was a good interaction, and I've heard from a small handful of other agencies that are interested in me showing up too. So that'll be a regular thing for me.
Yeah, if I can, I'd just like to expand on that. They're very curious about what we're doing. They really appreciate that TTSA is moving to be much more transparent in what we're doing, especially with the big project that we're embarking on in the land use study. Very curious, and they're one of the 5 agencies that make this happen. And Jason, you did a great job. The feedback afterwards was thanks a million. We really appreciate it. It gave us a much better view of what's going on over there and where you're going. We like that. And so I would encourage, whoever you represent to maybe, have Jason come in and do that presentation. It'll make a difference, I think. So, I just want to thank you for your job.
You're gonna be back to that. So one of the upcoming items of interest, December sure is sounding heavy, so I can't.
Take it out of my meeting.
This is gonna be a December item. I originally intended for it to be a December item. I have been, kind of casually talking to different, strategic planning consultants. And I've mentioned to each of you kind of individually that strategic planning is a little bit of a passion of mine, and I think that done well, it can be very impactful. Done poorly, it can be a waste of money and a pretty document that doesn't do anything. So it's it has to have a lot of buy-in and a lot of focus. So I was very selective. I did get a quote from a consultant that I attended a few of the classes they presented at a CSDA conference. Had an opportunity to have lunch with them a couple times during the CSDA conference. Got good feelings about their direction and how the intent of a strategic plan having actual meat in it and actual results based and, grading yourself at the end, that kind of stuff. So I asked for a proposal. I got that. I will provide it to all of the board members. You can all look over it. It's got a quoted price. It's got some additional add-ons that we might consider. Probably a few add-ons that we don't need to worry about. But it is the effort would primarily rely on the board and myself to develop a strategic plan that then second course would be me and management team identifying how that translates into action for the agency. So more to come on that, but I will email those out for your review and you guys can check those out. Upcoming high point items. So we are having our Thanksgiving staff luncheon tomorrow. Just because it's a staff luncheon does not mean that the board of directors are not invited. You are definitely invited. The annual appreciation and holiday dinner that we have, we will be doing it at the facility here. The board is definitely invited to that. We're going to send out some official invitations here, maybe already or in a short time. If you can't attend, I understand. If not, love to see you there. We always try to make it a little bit fun. This is TTSA after all, and we do things like that. So
It's a lunch this year, not a dinner.
correct. We are continuing our annual Toys for Tots toy drive. So you see our little thermometer out there that we're hoping to exceed expectations. We're also doing an online virtual food drive with the Sierra Community House. Mike, what was our goal for that?
We're trying to do 60 toys, 50 toys, 60 jackets, and $25 in food donations.
So we're continuing on going with that. We've had a 3 or 4 years now. We've been kind of working with these same organizations. So seems to work well. Other than that, I don't believe I had anything else. Do you have any questions for me?
And Dale, I see none.
And Bert's already brought in 2 sets of Legos, so he's got to run up on them.
Challenge taken. Well, thank you for a very informative board meeting. Any final comments from board members?
Nope.
Okay. And with that, no further business. I will adjourn the meeting. Thank you. Thank you, Dan and Dale, for attending.